Well, welcome to Personal Finance 131. My name is Jim Parker. I'll be the instructor this term. Today, what we're going to do is we're going to look at some things in terms of the syllabus, kind of the course outline, and the basics, a little bit of an overview of the course and personal finance and how to get you knowledgeable, what they generally call, financially literate. There's a lot to it, and a lot of things have changed, and there's a huge amount of advice out there, just about all of it bad. So we'll try and sort through and give you a kind of an unbiased look at personal finance. So first thing is we're going to talk about is the syllabus. Then we're going to jump into one of the chapters. Don't stress out about the book. First off, materials, as we'll talk about in the syllabus, the due dates are semi-flexible in terms of you hand in the homework in a batch assignment prior to the midterm. So obviously that's quite some time away. What you do need to do on a weekly basis is just do your video comment, but that's not a big deal. That's just a sentence or two commenting on the sort of the extra video that I'll post. Not me. Not this video that we're talking about, but there'll be some topic, and I'll have some random YouTube video, typically just a short one, and all you got to do is put down a sentence or so. You don't have to go on a big long paragraph narrative and make it scholarly. No, it's just to sort of check in and suffice the attendance thing. So if somebody asks whether you're engaged in the class or whatever, I've got a bit of documentation, which for some reason seems to be a thing with financial aid or whatever else is going on. So they want to make sure that people are engaged and that they're not just doing it all at once. But anyway, back to the book. It's pretty useful, but you don't need any of the extra materials. I'm not in the book selling business. I don't get a commission on that, thank God. I mean, well, sometimes I wish I did, but I don't know. I think selling crack or something else is probably a nobler pursuit than making money from your students. But that's just me. A little bit about me. I raise some dogs, whatever. I've kind of taken things easier in life now. I used to teach full time down at UAA, but now I'm just adjunct because I'm out in the valley and I got a bunch of other stuff going on. But Hungarian visas. This is actually in Budapest. I've got a couple daughters, one of which she's actually a nurse practitioner down in Utah. She's going through that program. She's already a nurse. These are the pups from this year, they're all, whatever, artificially inseminated from a dog, the national champion down in Missouri. So keeps the litter small. They're all sold before they're even born. So it just makes things a little bit better. Raise some horses, breed some horses. A bunch of equipment around. That's just a friend of mine. That's one of my tractors. Military background. I was in F4s, F-15Es. I've got a Yak 52, a little Satabria, some other stuff. This is the property where I primarily live. I ran it as a campground for a while, but I closed it down. You may know, whatever. Pioneer Peak is like right behind me there. This is the Connect River. It's a pretty good chunk. Then I've got some more property down there and some other property up at Chickalum. That would be, I think that's Abby. No, or I don't know, Dakota. I got a bunch of different horses. That's a little one. She's actually grown now. It was all covered with all kinds of riffraff when I took it over. So, but that was back in 2018. There's Layla. She's just a year old now. Ran some cattle, pheasant, a lot of pigs. Pigs are cool, but there's not too much money in agriculture up here. It's kind of a tough go. So I like to keep the animals on the property. I got ducks and sheep and all that kind of stuff, but it's tough to make it go at that. I do more with investing and other stuff than I do with agriculture. Background-wise, I've got an MBA, PhD. I did 23 years in the military. Then I went to work for a defense contractor, Booz Allen, pretty much a soul-crushing corporation. I don't do corporate stuff anymore ever again in my life, which hopefully you'll all get to be in that position if you're smart with personal finances. But working for yourself is obviously much, much better. But you got to get there. You got to have some capital to get that going, and you got to have some initiative and some other stuff. But it's far more rewarding. I did sell real estate just for a short time. That's a kind of a tough gig. You just have to. You can't do a bunch of different things and do real estate. If you're going to do real estate and do it well, you got to be 100%, 110%. In fact, my mentor, woman I was working with, who was really talented, super successful and all that, but she said, yeah, you got to get rid of your dogs and stuff. That's just a time suck. You can't afford to do that. And it's like, anyway, prioritization was what was kind of lacking in that field, so I left that. When I was in the military, even in addition to flying, I did a bunch of contract work, and that's kind of how I got in the business situation, and then I ended up getting the PhD because I was doing a bunch of military sales. At the time, we were getting helicopters from Lithuania and selling them to the Afghanis, and believe it or not, there's a lot of lease and business aspects to that, and just good travel. I lived about probably 14 years all in Europe. Still got a house in Germany, but I'm going to sell that to probably keep the money overseas. I'll probably buy something in Belize is what it looks like. Connect River Ranch. Actually retitled it now. It's just Parker Ranch, just for simplicity. And to kind of distinct myself from the campground. When I had the campground, I didn't want my own name attached to it because weird things happen. It's the Butte, it's Alaska, and you don't necessarily want your name tied to something. Yeah, this was the property. It's just short of 100 acres. I've got 338 down that way, 65 up in Chickaloon. So I've got a fair amount of property, but it's more of a great hedge against inflation and a great, pretty nice, stable investment. I dabble a bunch in, whatever. I do a bunch of crypto type stuff, which, if you know, is super volatile, and compared to real estate's kind of the safe place. So if you can make some money in something like crypto or tech stocks and then dump it into real estate, that kind of provides you a bit of less volatility. Volatility meaning that the price of things changes continually, and it's a little nerve-wracking. Real estate's pretty stable. Anyway, okay, so let's get into the syllabus. Try and get out of this thing real quick. What I'm going to do is go to, I'll just pull it up here. So, course 131, fall 2025. My contact information, business hours if you need them, text if you need it, email. So, again, don't stress over the textbook. Whatever edition you get will be fine. We'll sort out the homework assignments. The homework assignments, they vary between the different editions, which can kind of cause a problem, but we'll get things straight before the midterm when the assignments need to get turned in. As you know, there's a bunch of sort of boilerplate stuff that whatever that they would like included. It's all true. I'm not saying it's BS, but it's but more the nuts and bolts of what you guys are actually interested in. So homework, there'll be certain homework assignments. They'll be due as batch assignments prior to the exams. There'll be a midterm and a final. Then a project. You'll hate the project, but it actually does some good. It's a financial plan that's completely tailored to you. So we'll talk much more about that. But the problem with it that people have is that you have to, show some initiative and tailor it directly to you. So try to avoid just turning in some chat, GPT, whatever type of AI you like, garbage. try and make it something that's actually tailored to you. If it's just broad generalities, it does you no good, and it does your course grade no good, and it gives you no plan for the future. So we'll talk more about that. Participation, that's those comments on the video. So not a lot of points, 10, but they're easy points. I mean, people who want to get an A in this course they do get an A. People who blow everything off, yeah, go figure. It doesn't turn out well. But this is that term project. So about a month into the term, just a 5-page paper, not a big deal. But also about 5 years from now. What I mean on this is that for most of you, well, there's not a common, the average student is misleading. Some of you are immersed in your career. Some of you are, right out of high school. Some of you are, older. So your plan needs to be tailored to you. If you are, like, say, a student that's a full-time student, which is actually pretty rare, but if you are, and you're concentrating on school and just have some sort of side job, you probably don't have huge amounts of money to, be devoting a bunch of time and resources to coming up with a plan of what to do with it. But obviously you're in college to hopefully have a more sizable income in the future, and so that's what I'm trying to get at here, is that sort of advance yourself forward to when you're actually earning, not huge money, but at least a starting salary, and how you're going to allocate your money to basically get ahead. The goal here is not everybody's going to be super wealthy. I mean, if that's your goal, you can probably pull it off. But for most people, you at least want to be at the point where you don't have to worry about money. If you don't worry about money at all, if you don't do some planning, well, then you're going to be obsessed with money because you're going to be broke. I mean, it's very expensive to be poor. That's the whole system is set up fairly predatory in terms of extracting the maximum amount of money out of, the poorest folks. And believe me, I'm a capitalist and I'm all about wealth, but yeah, the system is set with all the payday loans and all the pawn shops and the unbanked and it's pretty vicious out there. So you need to have some skills. You need to have a plan, and we'll go through that and work on it. We'll talk about all these different things. You may not know a 401k from, whatever, tax deferred or any of that kind of stuff. We'll go through it. By the end of this course, you'll have an idea of all those things. So, yeah, YouTube, you love or hate it. I mean, whatever, I don't spend that much. It's, I think, 12 or 13 bucks for YouTube Premium to get rid of all the commercials. So I apologize for you all if you just got the regular one and you got to suffer through it. But, well, it's really the best way for us. I've tried some of the other video servers and they just, unfortunate. Class schedule. So here we are. I'm doing this on the 24th, so obviously you'll have it tomorrow. That'll generally be the thing. Early in the week, have a new lecture where we'll go over the slides. Then I'll post the slides, and then I'll post a little video, and you'll look at the video, and you'll reply right there on Blackboard, not on YouTube. Don't leave YouTube comments. Just on Blackboard, you'll see a little assignment on your student view, and you'll get your couple few points. And again, don't worry, you can catch up if you miss one. Midterm exam, that's done on Blackboard, multiple choice. We'll do a massive review before we go into the exam. That'll be its own video. So again, nothing to sweat there. Thanksgiving will take the week. A course summary, final prep, and then finals week. So again, it's up to you. If you want to do well in the class, you certainly um, can do that. You know, the majority of the students in this course, they either do really well or don't get a grade or, you know, fail, depending on the level of non-effort on their part. But anybody who puts in the time generally does pretty well. For example, the term paper. If you're, you know, worried about that, which a lot of people do end up worried about it, just submit it to me, you know, a few weeks prior. And, you know, what I'll do is I'll look at it and I'll tell you what needs to be done to get it up to the grade you want. If you want an A, I'll say, well, you need more content here. You need to add this or address this thing. It's usually just, you know, something you haven't, you know, said how you're going to, what type of insurance you're going to use or how you're going to save whatever or some aspect of it. That's usually just a missing component. And I send it back to you and you change that part and then you end up with your A. I mean, it's not that hard. So I don't have a whole, I'm not unsympathetic, but yeah, if you want to get a D or an F, you know, that's on you. That's basically a choice you've made. So the opportunity's there to get an A if you want it, and for most people, you'll take that option. Most everybody, you know, can get an A, will get an A if they apply themselves. Those who don't, yeah. So anyway, what's changed hugely and now I'm getting kind of broader, you know, concept stuff with personal finance. This isn't testable per se, but just things are changing so much out there, and there is so much advice that you get in the financial world that's just garbage. And maybe I'm more pessimistic than most of you, but I see a lot of this stuff on YouTube that's sent to me, and it's just bad advice, or just even friends who've given me advice, or even worse, people act like your friends that are on commission that are steering you to financial products that have a huge commission. You know, they're not your friends out there. For example, you know, whatever media you're on, whether it be, you know, podcast or you know, TV or whatever, people are trying to sell you gold. What they don't tell you is some of those companies are phenomenal ripoffs. I mean, they are. Gold would have to go up 2 or 3 times in price before you're even, you know, neutral. There are places to buy gold if that's your thing, and I'm not an advocate so much for gold. It's not a bad investment, but it's not the best by any stretch. But anyway, the first thing is, if you did want to buy gold, you don't buy it at a 200 or 300% markup off some, you know, whatever jackass who's selling it on a podcast. So anyway, you have to be careful with that. How did I get there? You'll see I tend to stray off on random things. Building your net worth. Net worth is really what we're you know, focused on. People will get obsessed about income, and income is just a small part of it. You know, I've been in positions where I've had incomes that are, by God, freaking astronomical. But at the end of the day, I was living in Europe, and my housing wasn't paid for, my kid's school wasn't paid for, and tremendous amounts of money were flowing through my checking account, but I wasn't really able to, you know, get my mitts on much of it. It just passed through. It came in on a check and left within a week. And at the end of the day, you know, I had $20 in my pocket. Then I've had jobs where I didn't make quite as much, maybe had much higher quality of life, and guess what? I still had $20 in my pocket. What you're concerned with is net worth, and net worth is your assets minus your liabilities. Now, you know, assets are things, you know, that, well, the better assets are the ones that appreciate. There are depreciating assets, ones that lose value, and appreciating assets, ones that increase in value. You want, obviously, appreciating asset. And liabilities that's debt. Those are basically people you owe. But again, that's not at all. It's used as a negative, but to tell you the truth, the wealthy are generally in debt, but good debt. You know, low debt, ideally debt that's tax deductible, and they're using that to buy assets that appreciate at a higher amount than their debt service. So, you know, they buy real estate that's going up at maybe, I don't know, 5-6%, and they finance it with money that they borrowed at a couple percent. And so the more they borrow, the more they buy, the more their net worth goes up. Now, income is kind of what you need to be able to start buying assets, but income itself, like I say, you know, it's taxed right off by the federal government. Assets are taxed at a lower percentage, and it's kind of sad, but you know, most wealth is generational and inherited. So if you want to sort of break that channel, that connection, you've got to introduce some new income into your generation to generate some assets and hopefully be able to pass them down to your heirs. So I'm not so concerned with income. Cash flow is nice. Cash flow is what I use to actually pay the bills. So that's sometimes income and cash flow. If you're poor, income is cash flow. You know, the deal is that the poor, they spend their money. They don't have a choice to save. Every dollar they get, they have to spend on something. Then you get the middle class, and they save their money, which is good. I mean, they have some access, but unfortunately, most of the time they put it in assets that don't appreciate that much. But they're a huge cash cow for the third group. The third group are the rich, and they invest their money. So they do save some, but they also borrow a lot. And they, you know, make investments that usually take advantage of the middle class to increase their wealth. You know, look at situations like COVID, for example, which was pretty devastating for most people. But a lot of the wealthy, they doubled or tripled their net worth during the period of COVID by being positioned in the, well, ethically it's not the right place, but the place they put themselves. So anyway, capital is what is going to generate that wealth. So in order to invest, you need money to work, and then the rules have changed. I've been investing for a long time, obviously, you know, my entire life, and I never agreed with people who said, "Oh, you need a certain segment of bonds, and you don't want too much in the way of tech stocks." And the bond thing, I kind of just put it off because I said, "Well, maybe I will get some bonds when I'm older." I'm older now, and I still don't like freaking bonds. They're not a great investment. But the other thing is that the tech stocks have just the wealth some of those things have generated. And believe me, I mean, I work with one brokerage, Fidelity, and they actually assigned me an investment advisor. When you get to a certain level, they say, okay, you know, here's a free consultant who's going to help you out. This poor dude, he was, I said, yeah, I bought some NVIDIA way back. And he's like, what's NVIDIA? For those of you who know anything about technology, or at least technology stocks, NVIDIA is something that it's up and it's going up. And anyway, I bought NVIDIA when it was $37 a share. Now, because it did a 10 times thing, a 10 times split, it's be the equivalent of about $1,800 a share. I mean, you don't have to buy that much stock to make good money. And now with crypto, with Bitcoin, I wish I would have bought more, but it was super sketchy back when I bought my first two, and I bought them for $700 a piece, and I sold one of them when the price got to $2,600, thinking that, you know, I was killing it. That would be worth I don't know, 100 something, 112,000, 125,000, whatever, within the current market. Super volatile, but right now it's down just a tad, but I'm not selling today, so I don't care. Okay, One other concept I want to cover before we jump into the actual segment of the book is talking about compound interest and the need to start basically saving money. And I'm not talking about, I'm not saying you're middle class and you need to stop with savings, but I'm saying you need to basically generate a nest egg to use for investments. And the vehicle we're going to talk about here is a Roth IRA. We'll talk more about IRAs in other segments, but I just want to impress upon you the amount of money you can save by using compound interest. Okay, so I know I'm throwing a lot of terms at you right now, but the key takeaway is just the power of compound interest. Compound interest, what that means is, as opposed to simple interest, like if somebody loans you $100 and they say they want 10% interest on it over a year, you would give them their $100 back plus $10. That would be 10%. If somebody says, well, I'll loan you $100, but I want 10% compound interest, what that means is that they're going to loan you that $100 at 10% interest, but compounded daily, meaning that you get the 10% and you divide it by the number of days in the year, 365. And so you get 1/365th of 10%, a very small amount. And on the first day, you add that interest to the amount of money that you're now paying interest on. And on the second day, you again add that little fractional amount on there. And it's just going to be a few cents, but by the end of the year, when you go to pay this person their compound interest, you may end up owing them, say, $115 because they've earned interest on interest, right? Only on the first day are you paying them the interest on the $100. On the second day, you're paying them interest on that original $100 plus the interest that they've accrued. So that's how compound interest works. Now, over the course of a year, not huge numbers, but over the course of 50 years, a lot of interest. So that's what we're going to talk about in these examples. So these charts are all going to be the same. This number is going to change. 5% in terms of an investment. I don't invest in anything that's only going to give me 5%. I'll take a little bit more risk to hopefully achieve a higher return. In fact, 8% isn't quite going to do it. Now, again, there's no free lunch. By taking more risk, by going into more aggressive investments, you have a chance of more volatility and potentially even more loss. And then the last case here is 10%. 10% is pretty much what the stock market has returned in the past century. So, going back 125 years. So the stock market, by and large, now if you get in, tech stocks and other things, again, more volatility, more risk, but they go up even higher. But even fairly conservatively, with a broad stock market investment, you can make about 10%. So anyway, we'll talk more about that kind of investing later. But what I'm trying to show you, again, is coming back to compound interest. So there's these different columns here on a spreadsheet. The one column is your age, and this next column would be if you invested the money according to this plan. So the deal with the plan is you're going to invest $500 per month, and you're going to do that just as it says here, $500 per month, which equals $6,000, but you're going to take 1 month off, say maybe December for Christmas or whatever. So $5,500 a year, and then at age 50 you're going to go up to $6,500 per year. So if you're doing it $500 a month, you're going to get there, and then you'd have $500 to spare. So anyway, if you start making those investments and you keep them in there till age 65, and you're compounding with a 10% interest rate, you're going to end up with a big chunk of money. What this is showing is that if you do that for the entirety, until you're age 65 according to this plan, at the end of that, you will put in terms of actual money, 273,500, right? But how much is it worth? You turn that 273,000 into $5.3 million. Now inflation's going to continue. What will you be able to do with 5.3 million? Well, a whole lot less than you will now, but just the same, it accrues quite considerably. And if you're a more savvy investor, you will likely, I've been able to achieve a rate higher than 10%. I've had volatility. I've had some years where it goes down, you make nothing, and you have other ones where you make 30. But on average, if I'm not hitting 15%, I'm not happy. And whatever, just depends how aggressive you want to be with it. Now, you don't have to be, totally obsessed with all this stuff, and unless you actually enjoy trading. But there are vehicles out there, mutual funds and other things, investment vehicles that are kind of hands off, and you just start investing your money, and you look at it once in a while, but it's not something you got to look at daily. In fact, it's better not to look at it daily or even weekly. Just don't worry about it, and certainly don't listen to news reports. So again, here's these numbers more blown up, and there's always opportunities. And what I'm saying is, you don't have to save all this money until you're at retirement. Sometimes, if you have some of these investments, you can change things up as you go through life. You'll see an opportunity. Not to get political, but there was a time back in the spring, if you remember, the stock market was tanking, and people were burning Teslas, and all this other stuff was happening. I had a little bit of cash on the sidelines, and I jumped in and I bought three things, but one of which was Tesla, and I was up 50% within about a month, and it's gone up even higher. So anyway, it'll still change, but that's on some of the other investments. I bought MicroStrategy and some other investments. But if you're just paying a little bit of attention and know psychology, it all works out. Just kind of as an aside, that the stock market is, if it's like everything else with media sources. They're when people are very noisy, there may not actually, that might not actually be the story. It's a bit like a roller coaster. When you're on a roller coaster, and let's say the stock market's at the all-time high, just like on a roller coaster, if you notice, there's that click click as you're getting to the top just before the ride starts, and then all of a sudden everything is quiet, you might be at a peak. And conversely, on the other side of the roller coaster, when you're back at the lowest point, that's where everybody's screaming, and that's where panic happens, and that's where people start dumping out of things. And not to say you want to be you kind of do want to be financially like a vulture and just buy the dip, jump in there, and it's amazing. Plus, anyway. Okay, enough of philosophy kind of stuff. We'll get back to the textbook things now. But it will all sort of be relevant when we go through and we talk about investing. You'll see where some of the things I talked about with compound interest and just sort of how money works. What makes sense. So financial plan, personal finance, broad terms. Yep, spending, financing, and investing to optimize. Right, but you got to have a plan. It's absolutely the case. If you don't have a plan, and again, there's lots of variables out there, but if you at least have a plan, you're modifying the plan as you go. If you don't have any plan at all, you're just making irrational decisions. The person who's there was somebody else on the other side of that trade when I bought that Tesla stock. There's some poor sap who thought, oh God, this company's going out of business. They're done. And, you know, whatever. They didn't have a plan. They didn't have any stops, and they just panicked and they sold at the bottom. Anyway, opportunity cost, huge thing. And this is how you acquire basically money, income, cash flow. Is if you're making an income, for most people, your skills are what they are, your chosen field is what it is, and you're going to make a certain amount of money that's, especially if you're in government type work, it's going to be set. I mean, you'll get promotions maybe along the way, but your income's going to be, semi-fixed, hopefully gradually increasing. But what you do control is what you spend your money on. And so that's where opportunity cost comes in. Opportunity cost, if you see some people do quite well with a fairly modest income, and other people just, living day to day on the same amount of income. And on the surface, they may look semi-identical, but then you see the other person not really tracking some of the killer things to their finances. They buy a new car every couple 3 years, a huge depreciating asset. They pay interest on that vehicle. They have credit card debt with huge rates. I mean, I'm telling you, I'm excited when I make at least 15% on an investment. People with credit cards are paying over 20 on the other side. There's two types of people. There's people who pay interest and people who make interest. If you're in the paying interest, yeah, you're on the wrong side. If you're making interest, that's a good thing. So, if you little things add up. I've never smoked, but my God, when I see somebody smoking, I guess there's obvious health concerns, but for me, it's like, oh my God, the amount of money that person, whatever. I don't even know what cigarettes go for. Maybe what, $12 a pack or something. You add that up at the end of the month, yeah, $400 or something, and they're driving a crummy whatever. They could be driving a, something cool, maybe an old 4Runner that's fully depreciated out, that is just trundling along and is a maybe not an appreciating asset, but at least isn't dropping like a rock. Anyway, people, if you make good choices, but yeah, we'll hit opportunity cost a lot as we go. Every decision has an opportunity cost. Everything you choose to forego. I mean, even right now as a student, if you're taking a whole bunch of student loan debt, and then when you get out of college and your peers are buying houses and you're servicing your student loan debt, there is a consequence there. There's a retribution. And now, again, getting through college is important, but just try to live within your means to minimize the amount of debt you incur. Financial advisors, I would go as high as 90% is just garbage. There's people who say, "Oh, pay off all debt regardless." I am not in that camp. I've made money by using financial leverage. Now, I'm not saying buy, crypto on using leverage, using borrowed money to buy crypto, but solid assets like real estate, that's how it's done, and that's how you make money. But when people are giving you advice, the first question is, why aren't they doing it themselves? Why are they on, especially if there's some person on YouTube or whatever. Yeah, people who are out killing it, they just do that. They're so busy making and spending their money, they're not necessarily going to share it with you. People who are selling courses and doing all of that other stuff, yeah. or people that are on commission or selling programs, whatever. Financial advisor. If you are an independent kind of advisor, somebody who works like a lawyer or an accountant, fee for services, I give you $500 a year, and you help me out financially in terms of making my decisions, but you don't have skin in the game. You're not trying to get me to buy and sell and generate commissions for you. Those kind of people can do quite well. Budgeting and tax planning, everything has tax consequences. In budgeting, we all do it to a certain extent. Granted, some people who live on a really strict budget, maybe they're not keeping track of the big things. I mean, you need to live in your means, certainly, but you need to eliminate the real drains to your account. But again, you don't want to be so frugal that you're not enjoying life at all. Liquidity means access to cash. So I've gotten this trap. I wouldn't call it a trap. I mean, it's a good trap to be in, but having more real estate and not that much cash on hand. But again, the real estate's an appreciating asset, and I would prefer to be in that position. Financing large purchase depends what the large purchases are. If it's something financed with a credit card that's a depreciating asset, that's a huge suck. If it's real estate that's financed at a very low rate, not the current rates we've got going right now, that can be good. For me, I've got farm animals. I raise different stuff, and so I get a better loan rate because I'm a farmer. If you didn't have access to that, to buy some of the property I bought would be pretty foolish. It'd be hard to get ahead buying it as investment property. Protecting your assets, so insurance, investing your money, and planning your retirement and estate. So retirement is for you, estate's for follow-on. What you can do though is get a nest egg. You need that capital, and once you have that capital, it will spin off income to you to get you through your retirement. And since you hope not to die penniless, that estate is passed on to your heirs or to a charity or whatever you choose to do with it. So budgeting, assets and liabilities. What you own, what you owe, and then net worth. So I covered this already, but a lot of personal finance people say, oh, get rid of all your liabilities. Well, get rid of your bad liabilities. Keep or even increase, the good liabilities. Different people psychology, spenders, savers. Investing is huge. I mean, you look at the price swings on different things, and they'll talk about, oh, markets are up today. It's all people at the end of the day. I mean, the people are the ones that are driving the prices up and down. So that's what makes investing pretty interesting, is because in essence it's a psychology program, and it's dealing with humans that are erratic. And if you can figure out patterns, that's how you make money. But there's usually somebody on either side. But here, the problem becomes when you partner up, when you get married or whatever, and here you've got the spender, and here you've got the big saver, and the clash. So that's why sometimes having a formal budget in that situation, at least you have something you can agree upon. Liquidity. So liquidity is that cash flow, that money. Cash and liquidity go hand in hand. Certain investments, real estate, very illiquid, hard to get money out of. Stocks, pretty easy. Cash is by definition liquidity. So money management, how you're going to keep enough in liquid form and take care of these short terms. So cash flow again. Credit management, what type of credit to use. So, yeah, I'm not, I don't have personal loans. I don't go to the bank and get business loans. I don't do that kind of stuff. I try to finance my own stuff. And I think, yeah, when I say good credit versus bad credit, just about all the credit I've got is on real estate. And, you know, real estate is tax deductible. So I guess under the new Trump plan, some uh, debt on American vehicles I think is going to be tax deductible. But it's a huge thing. Makes it more affordable. So money management, credit management, having good credit and access to credit is huge because that means that typically you'll have to have less money, available doing nothing for you or in some checking account. If you have money in a checking account and oh, but we're paying you interest on it, yeah, paying me interest that's well below the inflation rate, and it's also subject to identity theft and everything else. So having a credit card that has a high limit and a low or no balance on it, that's helpful because then when something bad happens, you can use it with a credit card. You can shift some money around. You can pay it by the month, and you'll pay no interest on that money. You'll just be what they call a convenience user. So loans, yep, college tuition, car, house. Anyway, different types of loans. Sometimes quite useful. If you're getting into a career that's going to pay well, it's a good investment. Car, you got to get to work, but you got to be careful. You got to look at needs versus wants, and maybe depreciation is the big killer with cars. And anyway, homes, you're a little bit more quality of life. It's a personal decision, but for me, I've had some super nice cars. I've had, I don't know, 7, 8 Corvettes and Vipers and stuff like that, all in Europe, where they were kind of cool. It didn't quite have the same stigma it did in the U.S. And I could, take them on the Autobahn and all, but I always bought the older classic ones that were, well, I'd always buy them cheap and sell them high on the European market. So you can have nice things, but if you're going to go to the car dealer and buy a new car every 3-4 years, yeah, you're going to have to overcome that. That's a real financial obstacle. So maturity loan, selecting a loan. Yep. Competitive interest rate. And it's also the timing. Right now, interest rates are pretty high on most things. Generally, lenders want to loan you money when you don't need it. and they don't want to loan you. Like if you have a great business idea and you go into a bank, it's really tough to get a loan. If you can afford it, if you're a good credit risk, you probably don't need the loan. It's just a strange way of doing it. For most of the businesses I've started, I've always wanted the business to kind of pay its way out. It means the business grows a little slower, but I want to make sure it's proven before I start expanding things. Self-financed. Insurance planning, yeah. So there's some legal requirements. Health insurance, it's kind of a nightmare. Still that way. It's very political. You'll see with most political issues that different parties on either side don't want to really find a solution because it gives them something to campaign for. Disability life insurance. Yeah, we'll talk more about that as we go. But times that are needed for life insurance and times when there's no need for life insurance. So plan for your investing. So again, don't have a bunch of stray cash sitting around unless you're waiting to buy the dip on something when it goes down. But the reason you're doing that is because you want a high return. Stocks, yes. Mutual funds. Mutual funds are basically just a broader range of stocks and real estate. As I said, I'm not a huge fan of bonds. And so I'm not going to, we'll talk more about stocks and bonds later. But risk and return are related. If I'm not saying take crazy risks here, but you got to take some risk in order to get the return that's going to outpace inflation and get you where you need to be. And it has to be compatible with you. If you're the kind of person that's going to panic at the bottom, if you're going to buy high and sell low, you're going to have to find a different type of investment. There's people that will encourage that and then love it when you sell at the bottom. So we'll talk a lot about in this course about different types of retirement vehicles, but especially now you'll see that the money in your retirement account, you can get access to that when you're still working age. I've bought several pieces of property with my retirement funds. It just was done in a real estate trust, and it was still under a 401. And then at a certain point, you can get it out of that situation. But they're changing the rules now where you can invest in crypto with your 401k funds. I bought into the ETF back when it was first offered through ETF means exchange traded fund through my 401k. So the money's set aside for retirement, but you can use it at different stages in your life. So building your financial plan. Yep. Enhances your net worth, builds your wealth. Net worth and wealth are very close. But you got to have your inflows and outflows so that you can make money available. We live in a capitalist society. You need capital to invest to make the big money. You need to get to the point where your money's working harder than you are. Working your entire life, number one, you kind of get burned out at a certain point. But number two, at a certain point, your income you make should not be that impactful to your overall net worth. You should have a large enough net worth out there where it generates more money than you can by working at some hourly job or even a salaried job. So components: cash flows is the money coming in, outflows the money you spend, budgeting is how you're going to set that up, and liquidity with excess cash. So the maximum amount of money that's not needed for this income and spending should be invested where it's getting a higher return. So we're getting a little repetitive here. We talked about budgeting. We understand that. Budgeting decisions. Job, cash, product, services. Yep. The best way, in fact, I think the video of this will be on paying yourself first. What people will often do is they'll say, well, yeah, I know it's important to invest, but I need to get all my expenses covered, get the cash flow set up, and then any money that's left at the end of the month, I'll go ahead and invest that. And what invariably happens is people spend that money. They'll come up with, the whole needs, wants things gets distorted, and all of a sudden they'll buy this, buy that, and that money that they were going to invest, there's no money left at the end of the month. So when you're setting up a budget, one of the best ways to do it is maybe pick a percentage like 10-15% and have that as your investment amount each month. And so say your rent's $500 and your investment amount is maybe rent $500, that's pretty small, but anyway, you come up with some percentage and you just make the investment amount just basically a payment into your account and a separate account, a mutual fund or something, where it's actually buying stocks, and that's how you do it. So you just treat it like another bill, and that way you'll consistently invest and you'll accumulate that money. So this guy will, in the video, I think it's the guy with the hands, he sits there and talks, and he talks about this whole richest man of Babylon. I think he's trying to sell a book, whatever. But his basic philosophy is, almost there. Things you can do in life to change your financial outlook. Leasing cars, nah, generally not a great deal. Borrowing money to purchase a car, if it's at a good rate. But again, look at the car itself. Do you need a brand new one? Can it be a couple years old? Borrow money to purchase home? Typically, yes. We'll talk more about that. How much cash we'll need to borrow, a long period. Anyway, we'll go through all these different aspects as we go through the course. Protecting your wealth, insurance. So it's a necessity. Obviously, it's a legal necessity to drive, but the life insurance, liability insurance, things like that for general property, some are mandatory and some are optional, and we'll address both. But you do need, and again, there's a lot of products out there that are sold by people on commission that may or may not have your best interest at heart. Personal investing. We'll talk about that in great deal towards the end of the course. And estate planning. Again, the place where you'll probably keep your nest egg is going to be in your retirement account, because it's generally taxed at a lesser rate. It's added to by your employer if you're doing that. So there's lots of reasons why you end up with most of your wealth in your retirement account. Summary. Everything is integrated. Cash or use of cash. Things you can do. Some of these things are short-term kind of stuff. Cash and insurance. Most of these are, I don't have any insurance policies. Insurance policies that have a cash value are generally a joke financially. Sell some of your investments. Well, now you're killing the cow, the golden goose, whatever. Withdraw money. Most of these are just short-term fixes that really could be fixed by having a better plan, reserve in finances, and being able to draw upon your nest egg, which I guess is withdrawing funds, but you're going to put that money back. Use of cash. Yep. Okay. So as we go through the course, you'll see the slides will be in here, but what we're going to do at the end of the lecture just prior to the midterm is we're going to consolidate everything down into a single video, and I'll say, I'm not teaching you the test, but I am teaching you the important elements that, oh, by the way, are testable. So you'll get to where you need to go. So if you're overwhelmed thinking that you've got to, know all these little things and make lists and stuff like that, no. You're thinking you need to know formulas and memorize this and that, no. But you do need to know general concepts. You need to know what liabilities are. You need to know what opportunity cost is, and how compound interest works and things like that. But those are important things. So budgeting, liquidity, financial decisions, insurance decisions. And then it comes back to investment decisions and then retirement. So, the integration aspects. Psychology is huge. You'll see people that will guess stock prices and all this other stuff. It's called technical analysis. And they'll look at the charts and they'll look at patterns. And if you break it down to its simplest form, all they're doing is they're saying this is how people react, this is how people act. It is all people at the end of the day who are buying, or I guess AI, but AI that's programmed by people. So it still reverts back to human thinking. You'll evaluate things maybe as we're going through the course to see kind of where your money's going, and how you're going to get money to, you know, believe me, I've made some stupid financial decisions along the way, but by having a little bit extra money around now and then, I've been able to, you know, buy Nvidia when it looked like a good deal, buy some Bitcoin and Ethereum, Solana, and some other stuff when it looked like a good deal, and it pays very well. But you got to have that extra money around, which means you got to live within your means. You've got to budget things, and hopefully have some income and some luck. Not everything's going to work out, but if the big ones work out, it dwarfs all the small stuff. Yeah, so we discussed some of this. So the homework. So this is how the homework will be done. Now, see, the homework will not be turned in individually. Turn in a bulk assignment, so don't worry about that. Excel spreadsheet, we talked about this. If you're paying attention, you would have noticed that it was 5.3 million bucks. So from $500 a month to $5.3 million, that's a huge change. That is compound interest. So anyway, hope you enjoy the course. I think we went on probably about an hour, so we will call it here. Ooh, right at an hour. And this will be about the length. We won't have as much admin next time, but hopefully we'll be able to get into some details, and we'll go through all the different aspects. And this, don't get overwhelmed. Like I say, you'll do well on the test, guarantee it. If you listen to the lectures, look at the material, and just have a good outlook on things. We'll talk to you then.